My objective there is actually to get people kind of angry so that they realize, hey, I've been screwed. But the positive news is that technology and developments and the things that are going on in the world are leading us to a system where the money won't be broken anymore, in my opinion. And once that happens, things will be very good again, very much the way they were more in my youth. But there's going to be a transition period between here and there. And it's, nothing's a straight line, but we're going in the right direction.
Hey guys, welcome to Everyday Finance. Larry Lepard predicts that Bitcoin is likely to face a significant short-term crash before it begins a powerful rally toward a long-term target of $250,000. He attributes current market instability to a mix of macroeconomic pressures, shifting investor sentiment, and mounting geopolitical uncertainty, factors he believes are creating both risk and opportunity. Lepard emphasizes that despite recent volatility, this period of turbulence is part of a broader transition phase. He argues that temporary weakness in Bitcoin's price doesn't reflect its long-term potential, especially as global financial systems come under increasing strain. Key catalysts such as inflation concerns, central bank policy shifts, and declining trust in fiat currencies could ultimately drive massive capital inflows into scarce digital assets like Bitcoin. In his view, the path to $250,000 won't be linear. Instead, it will likely involve a sharp correction that shakes out weak hands, followed by a sustained surge fueled by renewed demand, institutional adoption, and broader economic shifts. For investors, Lepard sees this as a rare window to position strategically before the next major leg up. Watch ahead.
Yeah. So in general, I mean, it involves just covering the problem a little bit first. I mean, the problem is that GDP is growing slower than debt. Debt continues to get bigger and bigger, and eventually that becomes unsustainable. And then they're going to have to print a ton of money. And the underlying problem that the book talks about, Brian, is inflation. And that we've got a system that requires inflation, and it actually requires increasingly worse inflation, as one of the quotes in the book talks about. And so, and inflation, hurts the average person. I mean, the people who are wealthy, who have assets, who know how to borrow cheaply and invest in good things, they get richer. And the book points this out, in the beginning. I mean, 1% of the country owns 92% of the wealth. Really unfair. The working man, he doesn't really have assets. He doesn't necessarily know how to play the game. He can't borrow cheaply. He gets screwed. And so, and it's all because of inflation. And the inflation is all because of the money printing. And it's not greedy corporations. It's the Federal Reserve and the monetary system that we have that's been set up to benefit them and the people who, are on that side of the ledger. So what's important in history, and what history shows through many examples, is that having a sound monetary unit, which is to say a unit that does not change in relative value very much over time, allows people to coordinate with one another in a more effective means and prevents bubbles and busts. And therefore, there's greater overall prosperity because of, productivity and efficiency. So, and historically, that sound monetary unit was gold, because it was the soundest form of money we ever had. Been around 5,000 years. Supply only grows at 1.7%. And up until 1971, we're still on a quasi version of a gold standard, not the old classical gold standard, but at least the gold exchange standard. It kind of somewhat constrained money printing, didn't perfectly, but it held it back a bit. Post 1971, then all bets were off, and it's only gotten worse, as the book shows, the chart shows. And so, if we really, the solution that you alluded to, if we really want to go back to a productive, fair society, in my opinion, the book advocates for, talks about, and shows why, we need to return to a base layer of money that is sound. And the two natural choices are gold and Bitcoin, and there are positives and negatives to both of them. And it's unclear which one will be selected. Probably gold gets selected first, and then ultimately I think we go to Bitcoin, because we live in a digital age and gold is analog and it's harder to verify and so forth. But they both have merit, and they're both sounder than fiat by a large, large measure. And so, the bad news on the, is that the money is broken. And the first half talks about that. And my objective there is actually to get people kind of angry so that they realize, hey, I've been screwed. But the positive news is that technology and developments and the things that are going on in the world are leading us to a system where the money won't be broken anymore, in my opinion. And once that happens, things will be very good again, very much the way they were more in my youth. But there's going to be a transition period between here and there. And it's, nothing's a straight line, but we're going in the right direction.
Since the April 1st Wall Street Open, Bitcoin has entered a period of intense volatility, oscillating near the $83,000 mark as traders brace for a decisive move. The key resistance level at $84,500 is being closely monitored for signs of a breakout, while $80,000 acts as crucial support. This price action unfolds against the backdrop of heightened macroeconomic uncertainty, especially with the U.S. tariff Liberation Day on April 2nd, fueling concerns over a potential recession and further market disruption. Investor sentiment is mixed. While many remain cautious, some are strategically positioning themselves for a potential recovery in the second quarter. These participants are buying higher strike options and implementing downside hedges, indicating both optimism and wariness about near-term risks. Adding complexity to the outlook, Asian markets have shown tentative signs of strength, injecting a dose of optimism. However, global economic anxiety continues to weigh heavily, with fears surrounding trade policy, inflation, and monetary tightening dominating the conversation. In this climate, Bitcoin's price movement is not only a reflection of crypto market dynamics, but also a barometer for broader financial sentiment. Watch more.
Well, we'll get into that, but let's go back to your first point with about the 2000. I'm with you. In 2008, oh, this is it. Fiat's dead. We've seen the problem. Look at how they're printing all this money, and yet they changed the rules. They paid interest on excess reserves. They did all kinds of things to hide the inflation at the consumer level and push it into assets. And so they built up the everything bubble that we now live in. And yes, you're right. I mean, they've been pretty good at can kicking, and I was pretty wrong when I thought 2008 was the end. And here we are 16 years later, and we're still dealing with the same problems. However, the problems are getting, the spasms are getting closer together, and the amount of money printing is getting larger with each event. And, the system, I think, is coming to some kind of a conclusion or a denouement within the next, 5 to 10 years at the most, arguably even shorter. But to address your technology question, the fact that we now have the internet and we now have decentralized information is kind of breaking down. I mean, the book talks about how the world kind of got centralized during the 20th century, right? I mean, it became, scale economies suggested that building big organizations was cheaper than little. The assembly line, Ford, big steel, all that stuff. I mean, the way to make a lot of stuff cheap was to get scale. And what happened is World War II kind of showed us the limits of scale, which is you can get a very centralized world with very centralized groups. And guess what? If a madman gets control of your country, he starts a war that kills 40 million people. And so centralization, while it has its benefits of scale, it has its negatives of, the guy at the top can mess it all up in a big way. And fortunately, the microprocessor and technology have led to decentralization and are driving that decentralization trend, which is very important. And so we've got an internet now that's disintermediating the mainstream media. We've got guys like you doing podcasts. We've got, guys like Joe Rogan, spreading, information, et cetera. And so, these kinds of things are changing the discourse, and people are getting smarter and smarter about what's really going on. And the same is true with money. I mean, the Fed has always controlled the money supply, and they do it by jacking interest rates up to 20%, which almost bankrupted my father, or taking them down to 0%, which blows a big bubble. And that's just, it's nuts. I mean, it's the price of money is a price, that should balance savings with investments. People who have savings, they want to get a return. The people who they need money for an investment for a project to make the world a better place, to provide something, productivity wise. They need to borrow from the people with savings. And so those two should agree at a price where the supply of savings equals the demand for investments, and that's the interest rate. As a practical matter, that's not what we've got. We've got this Politburo called the Fed that jacks interest rates up and down, and it leads to all kinds of misallocations and all kinds of economic stupidity. And therefore, we're not as well off as we should be or would be if we had, interest rates set by the market. So that's kind of the fundamental thesis of the book, that we need to go back to a market-based pricing of money, and that to do that, we need to get the money out of the hands of government. And so the two forms of money that the government really can't control, although they've been pretty good at suppressing the gold price, are gold and Bitcoin, because they are money outside of, the government can't print gold and the government can't print Bitcoin. The Bitcoin is an algorithm, gold is a mineral, it's limited in supply in the Earth's crust. And so there's a natural limit on how much inflation we can have in those two assets. And that's the sad part. I mean, look, the enlightened, I mean, if somebody made me king or president or whatever, I would say, hey guys, we got, in fact, I put a presidential speech in the book, right? Say, hey guys, we got too much debt and that's a problem. And we follow the wrong model, which is Keynesianism, and that's a problem. And what we need to do is restructure the monetary system and use sound money as the base layer. That's pretty simple. We should do that. Now, the odds of that happening today, sadly, are pretty low, because most politicians aren't enlightened enough to understand that. And most politicians really generally only react to something that either get them reelected or prevent them from getting reelected. And usually what might prevent them from getting reelected is severe pain in the economy. And so sadly, yes, as you point out, it might require, economic pain to get people to suddenly focus more on the sound money issue, and then elect politicians that would, focus on it and fix it. And again, part of the reason for the book is, you understand sound money, I understand sound money. There's a whole community of us that understand sound money, but what are we, maybe 5% of the population tops? I don't know. Certainly not that percent. We used to be 1%, but it's getting bigger. We're growing because the problems are getting more acute. Well, we need to get half the population to understand that this is the issue. And then, of course, what will happen is politicians who will emerge will say, hey, look at that half of voting bloc. They want sound money. Guess what? I'm a sound money politician, because that's what we elected. And so that's kind of the way it's got to go. Now, I think sadly to get to that stage, unless my book catches on and we sell millions of copies and everyone reads it and the world comes to the same conclusion I've come to, which is probably unlikely, to get to that stage is going to, as you describe, it's going to take more pain. But maybe not as much as you think. I mean, I think if we have a severe economic downturn and inflation continues to go up, that's the dreaded, stagflation, where both sides aren't working. The economy is not working, people are unemployed, and costs are going up. Boy, that's really bad. And my sense is if things get really bad, then people will start, asking around and saying, what the hell's the problem here? And then maybe someone will read my book, or some politician will read my book, or one of these big, voices will get out there and say, you should read this book, and we'll get a movement going, right? And there'll actually be thousands and thousands of people, maybe even millions of people who are like, God damn it, let's return to sound money. So that's, I know that's arguably naive and I'm dreaming, but I don't think it's impossible. And certainly over a longer time frame, I think it's likely, because I think as the problem becomes more apparent, more people will understand it and want that, right? So therein the reason for writing the book.
Vivit, once a prominent player in the crypto space, has announced the closure of its NFT marketplace, inscription platform, and initial DEX offering, IDO initiative, effective April 8th, 2025 at 4 p.m. UTC. This decision comes in response to a steep and sustained downturn in NFT market activity. Daily trading volumes have collapsed from $18 million a year ago to just $5.34 million, signaling a significant decline in investor enthusiasm and transactional demand. The move marks more than just a business adjustment. It reflects a critical turning point in the evolution of the NFT sector. Experts suggest the NFT market is shifting away from its speculative phase, defined by hype, inflated prices, and rapid flips, toward more sustainable, utility-driven use cases. These include applications in gaming, artificial intelligence, digital identity, fan engagement, and intellectual property verification. Vibit's strategic retreat mirrors a broader industry realignment, where platforms are beginning to prioritize functionality and long-term adoption over short-term gains. The closure underscores the challenges faced by companies that scaled during the NFT boom and now must recalibrate amid shrinking volumes and changing consumer expectations. Ultimately, this signals the start of a more mature phase in the digital asset landscape, where lasting value and real-world application are poised to define success. Thanks for watching.